So in our last class, we discussed issues of on project viability, and that is why the issue of taxation is being brought in investment appraisal. So if management objective is to maximize shareholders' wealth, then their focus should be on cash flows generated, which are available to the shareholders. So the issue of tax cash flow is very important to the management. So the issue of getting cash flow after tax is very important. Now, in most questions, there will always be certain assumptions, such as tax is payable 1 year in arrears. Where you see such statements, what does that imply? It means tax for year 1 will be paid in which year? In year 2. Tax for year 2 will be paid in year 3. Tax for year 3 will be paid in year 4, except otherwise stated in the question. Now, take note, where there is tax payment and there is tax shield, and tax payment is stated to be in arrears, also the issue of tax shield, tax savings, will move hand in hand with the tax payment. So where we have tax payment in arrears, tax shield, tax savings will also go in arrears. Take note of that. And once a question states that at the beginning of the year, at the beginning of year 1, it means it will be at year 0. For example, when a question made it clear that investments will be made at the beginning of year 1. At the beginning of year 1 implies what? Year 0. When a question states that at the end of year 1, it means that you will record that transaction at year 1. But where it is stated at the beginning, it means just at the commencement of the year. And it will be stated in year 0. At the beginning of, you will record it in year 1. Take note, these are some of the issues I discovered in the last diet that some students were finding it difficult to understand. When the question states at the beginning of year 1, it means you are entering that transaction in year 0. At the end of year 1, it means it will be recorded in year 1 actually. At the beginning of year 2, it means it will be recorded in year 1. But at the end of year 2, it will be recorded actually in year 2. Take note of that. At the beginning of year 3, it will be recorded in year 2. At the end of year 3, it will actually be recorded in year 3. In year 3. I don't know if you get this logic. Yes. So some questions will tell you at the beginning of year 1, it shows that entry should be in year 0. So these are some issues. But when we start solving questions, but some students will say, but it is stated that it as at year 0. That is as at the end of year 0. That is the implication of that statement. So in solving issues of tax in relation to investment appraisal, we talked about various forms of allowance. That tax allowable depreciation, otherwise known as capital allowance, is used to reduce what? Taxable profit. So there are various forms of qualifying capital allowance. We have initial allowance, annual allowance, balancing charges. And take notes, when solving a question, working capital, issue of tax does not affect working capital. Maybe you are giving working capital in a question. Note, working capital is not affected by tax. So let's read this question. Somebody should read so that we can solve.
Now let me read, sir.
All right.
Okay. Example: Juliet Limited manufacture motor vehicle components. It is considering introducing a new product. Charles, the production manager, prepared the following projections as proposal. All figures. Should I read it one by one, or all figures assumed to be correct?
No, just write them. Just write them.
Okay. So I have to screw up, or should I check? Okay. Charles has recommended to the board that the project is not worthwhile because the cumulative after-tax profit over the 4 years is less than the capital of the project. As an assistant accountant at the company, you have been asked by the chief accountant to carry out financial appraisal. He does not agree with Charles' analysis and provides you with the following information. The initial capital invested and working capital will be incurred at the beginning of the first year. All other receipts and payments will occur at the end of the year. The equipment will cost 10 million naira. Additional working capital of 1 million naira. The additional working capital will be recovered in full as cash at the end of the 4-year period. The equipment will qualify for a 25% per annum reducing balance written down allowance. Any outstanding capital allowance at the end of the project can be claimed as balancing allowance. At the end of the 4-year period, the equipment will be scrapped with no expected residual value. The additional working capital required does not qualify for capital allowance, nor is it an allowable expenses in calculating taxable profit. Juliet Limited pays income tax at 30% of chargeable profits. There is a 1-year delay in paying tax. The company's cost of capital is 17%. Required: write a report to the director evaluating the project using net present value techniques and recommend whether the project is worthwhile.
All right. Thank you very, very much for that. Yes. So looking at this question, don't get scared by the additional information. Yes. Don't get scared by it. Sometimes when we are served with questions and you begin to read additional information, as you are reading, you are asking yourself, where will I start from? Yes. The point is, you will definitely start by writing on your answer sheet. So, and what you will write is a function of what you know. It's a function of the practice you've done at home before stepping into the examination hall. So, looking at this question, that we are to write a report to the director evaluating the project using net present value techniques and recommend whether the project is worthwhile. Before you can write a report, you must solve. You must solve. You must show your computation. Your computation is a major thing. It is when you compute rightly, you can now make a recommendation. Yes. As far as this class is concerned, it is the computation that we are concerned about. It is when we can get our computation right, then we can now write a report and make a recommendation. that's based on the above computation. Yes, it is therefore recommended that this, that. Yes. So to solve this, we're going to go by the format we presented in class the other day. Yes, I gave a format. So looking at this question, we have that the initial capital invested and working capital will be incurred at the beginning of the first year. At the beginning of the first year. The meaning of this is what? The meaning of this is what? I just
That
explained.
it will occur on
Year
zero.
zero.
Year zero.
Yes, zero.
At year zero.
Fine. If it is at the end, it means year one. Yes. Take note.
Year one.
Literatures, textbooks might not explain that to you. So all other receipts and payments will occur at the end of each year. You can see that now. At the end of each year. At the end of each year. So the equipment will cost what? This is an outlay. The equipment will cost 10 million. The additional working capital will also be 1 million. The additional working capital will be recovered in full as cash at the end of the 4-year period. So this investment is for a 4-year period. So by the time the investment is winding up, there should be a return of the working capital in form of inflow. But as at the beginning, it is an outflow. It is an outflow. That the equipment will qualify for a 25% per annum reducing balance written down allowance. So it means that for you to get your capital allowance, you use the reducing balance approach. And as you solve that, you get your tax savings. You get your tax savings. So the equipment, okay, any outstanding capital allowance at the end of the project can be claimed as what? Balancing allowance. Balancing allowance will also enjoy tax savings. Tax savings. So at the end of the 4-year period, equipment will be scrapped with no what? Expected residual value. It means the residual value will be what? Zero. Will be zero as at the end of the 4-year period. And the additional working capital required does not qualify for capital allowance, nor is it an allowable expenses in calculating taxable profit, which I've mentioned that working capital tax does not affect issues of working capital. So some of these stories are just put there to test your understanding. So Juliet Limited pays income tax. It means your tax rate will be what? 30%. And there is 1-year delay. It means year one tax will be paid in which year? Year two. Year two tax will be remitted in which year? In year three. So the company's cost of capital is 17%. It means your discounting factor to get your present value will be what? 17%. This is your cost of capital. This is your cost of capital. So to solve this, based on the formats we presented, we need to determine our cash flows, our relevant cash flows. Now, the first to determine our relevant cash flow, based on the format presented in class, we have our sales. Isn't it? For those of you in class, we have our sales.
Yes, sir.
So we have our sales. So we can have, I'll just use this. We can have year zero. We can have year one. We can have I just want to use this table for everything. So that is why I'm trying to include the years. Year one. Year three. Of year four. For now, let's leave it at this point. So the first entry, based on the format we presented, will be our sales. our sales. The sales value is what? Is 8,750,000. The million is suspended up here. Take note. So I'll just be working based on thousands. So the sales for year one is what? 8,750,000. You all have the question. I might not be
Yes,
going
sir.
scrolling up. So we have sales for year one because these transactions are occurring as at the end. Take note. Somebody will ask, why are we not starting from year zero? The question made it clear that the transactions commence as at the end or occur as at the end of each of the years. And that is why we are picking it in that order. So for year one, the sales is what? Is 8,750. For year two, it is what? 12,250. For year three, it is what? It is 13. Please put your question on the chat box. Let me see what you have to say. 14,350. Is it a question? All right. So what's next? Haven't determined yourselves. What next? We have our variable cost. Our variable cost based on the format. Based on the format. So what are the various variable costs in the question? The various variable costs. We have direct material, direct labor, direct overhead. They are the variable costs. So what are we going to do to them? We're going to less. We're going to less. So less variable cost. If you like, you can add everything, but I want to show it one after the other. Yes, I look at the solutions forwarded to the platform before the class commenced. Yes, I can see some good attempts. Yes, some good display of the concept, but some with some little issues anyway. Yes, but I think it's a good attempt. So let's variable cost. The variable costs we have include, we have direct material, For year one, the value of direct material is what? 1,340. For year two, it is what? It's 1,875. And for year three, it is what? 2,250. And for year four, it is what?
Two,
2,625. The next form of variable cost is what? Direct labor. I believe everybody in this class know why these are variable costs. They are costs that are traceable to the production process, and that is why they are direct. Yes, if you are not producing, you will not incur them. So they varies with the production process. In case you are still wondering why are we picking these values. So we want to get, what we are driving at is that we are trying to drive at our net cash flow. We're trying to determine our net cash flow. So it means your inflow in form of cash, less your outflow in form of cash, and any other deduction such as tax, addition such as tax savings will lead us to get our net cash flow. Our net cash flow. And that is why we are deducting these expenses. This is an inflow in form of cash. These are outflows in form of cash. And that is why we are deducting them. So now the next form of variable cost is what? Direct labor. Direct labor. For year one, the value of direct labor is what?
2,675.
4 year
2,675.
for year one, the value of direct labor 2,675,
675.
and this is 3,750, and this is what 4,500, and this will be 5,250. The other form of variable costs in the question is what? Direct overhead.
Direct overhead.
In year one, it is what? 185. In year two, it is what? 250. In year three, also 250. In year four, also 250. I'm not putting it in brackets because I've already said less here. If I didn't put less, I could have put them in jackets. But because I said less, I'm just leaving them open. So I should know that sells less this variable cost. So now, if you go to the question, you see other items. The question is, why are we not including them? Depreciation. Why are we not including depreciation?
No,
Because it's not a relevant question.
Yes. We talked about relevant cash flows. Yes, it is not relevant. Does not involve movement of cash. It is just a provision. Yes, it is just a provision. Does not involve movement of cash. So it will be ignored. So depreciation is not a cash flow. It's not a cash flow. What of interest? Interest. Are we going to include interest?
No, sir.
No, sir.
Because cost of capital is provided.
Very good. Including interest will imply that we are doing a double counting. In the last class, I said double nipping. Yes, it means the essence of interest is meant to account for time value of money. So the time value of money has been accounted for by determining the cost of capital. The cost of capital. So because we have a cost of capital, the interest is already embedded in the cost of capital. So there is no need for it. It is not relevant. We have profit before tax. Fine. We have income tax. This income tax, what do you think about it? This income tax.
Just it's a provision.
Wow. Yes, it's also a provision. It's also a provision. So the point is this: NPV is based on cash flows, not accounting charges. Take note of that. It's based on cash flow, not accounting charges. So net present value, that is NPV, evaluates a project using actual cash inflows and outflows. So an income tax provision is an accounting estimate. Just as I have said, it's also an accounting estimate. And this income tax is created under the accrual accounting to match with what? Tax expense with accounting profit. So it does not represent cash paid in that period. It's just a provision. So we are also ignoring it. We are ignoring it. So only tax that is paid in cash is relevant. Is relevant. In a question where we are giving interest, yes, I'm trying to read your question. In a question where we are giving interest, but they didn't give working capital, how do we solve it? Okay, I think the question you're trying to ask is in a question where we are giving interest, but we are not giving cost of capital. I don't know if that is because interest and working capital, they are two different things. But I think you can match your interest with the issue of working capital. So the point is where you are giving interest and the interest is in your accounting, in your financial data, you will also ignore it. And definitely the questions will also always give you your cost of capital. We always give you your cost of capital. So where you are not giving your cost of capital, there will be variables for you to determine your cost of capital, for you to determine your cost of debt, which you are going to use as a discounting factor. I don't know if that is fine, Madam Chikodili.
Yes, sir.
All right. So the issue of income tax will also be ignored. So the question now is, what will be your cash profit from what we've solved? What will be your cash profit? That is your sales less the variable cost.
Year 1, 4,450.
Year 2, 6,375.
6,375. Year 3,
6,300.
and year 4, 6,000
225.
to 5. Fine. Now, on this cash profit, you can determine the tax payments on this cash profit. Take note, you can solve this question in 2 ways. I discovered one of the students that forwarded the solution, he solved it in the other way. And that is very good. He solved it in the other way. Let me look at it. Yes, that is Mr. Igbayi Maslum. Yes, he solved it in another way, which is fine. He determined his capital allowance from the sales. Okay. Yes. All right. So you can solve it in different ways. This is as payment is at what? So the tax rate my work. So every workings, I will apply every workings in this table. Take notes. Tax payments for year 1 will be what? Based on the cash profit.
1,365.
Fine. 1,365. But if you go to the additional notes, the question states that what? Tax is paid in arrears, right?
Yes, sir.
So that
Yes,
136,
sir.
will you record it under year 1?
Under year 2.
Yes, sir. Year
Under
2.
year 2.
To be paid in year 2.
Fine. So I'm just trying to, instead of having another table for my workings, I want to use this 1,365. Fine. So tax payment for year 2 will be what?
$1,913.
Because it's an outflow. That is why I'm putting it in brackets. It's an outflow. 1,913. So for the next year, it will be what?
1,890.
So we have it as
890.
1,890. For year 4, it will be what?
1,868.
1,868. Now, the next point is the issue of our tax savings. Tax saved on capital allowance. How are we going to go about that? Tax savings. Who can give us direction to determine our tax savings?
We need to determine our capital allowance.
Yes,
Then apply
I think
the 30%.
based on what we solved in the last class, let's present another table to show that. Let's present another table to show that. So calculation of tax saved on capital allowance. Capital allowance. Now, in year 1, what is the value of the assets we've incurred?
10 million.
Right. So in year 1, the cost is what?
10 million.
10 million. So the capital allowance as at year 1 will be what?
25% of 10,000.
Capital allowance at what? At 25%. 25% multiplied by what? 10. This is the depreciation now, but instead of saying depreciation, we say capital allowance. So the value will be what?
25.
2,500.
2,500. Your tax savings will be at what rate?
30%.
30%.
Tax savings at 30%. We are using 30% because that is the tax rate. So I'm saying this because of those that might be joining for the first time. So 30% of 25 will give us what?
750.
To give us 750. So this is the tax savings for year 1. Now, what will be your tax written down value as at year 2?
7,500.
7,500.
So it will be 10 minus 25, you have 7,500. Your capital allowance, this tax written down value in our normal FR, it is called carrying amount. But in tax palace, it is referred to as what? Tax written down value. So your capital allowance as at year 2 will be what?
1,000,000. 1,100. It's 1,875. Sorry.
It's 25% of
No.
so we have it as 1,875. So your tax savings will be on your capital allowance at the rate of 30%. So 30% of 1,875 will give you what?
562.5 or 563 approximately.
563 approximately. Now, what will be your tax written down value as at the 3rd year?
5,725.
75 minus 1,875, 5,625. 5,625. So the capital allowance will be what?
1,688.
25%
Oh,
of 5. So this is using reducing balance approach. Take notes. So we have it as what? 1,000.
Oh, sis.
So the tax
406.
savings will now be what? These will be what?
421.787 for 422.
This one, this one, this one.
So now, for the fourth year, the tax written down value will be what? 5625 minus 1406. So the carrying value as that, or the capital allowance as at the fourth year will be what?
$1055.
We have it as 1055. So what will be your tax savings?
316.
So this will be what?
316.
Approximately?
Yes, sir. Hey, go back. Go back. All right.
Because I need some bacon.
I'm busy.
So the tax written down value as at the end of year 4 will be what?
3164. 3164.
So tax written down value is to give us what? 3,164. When you go back to the question, do you have any value for sales for scrap value?
No, sir. No residual.
So we now have it. Now we're trying to get our balancing charge or balancing allowance. We're trying to get our balancing charge or our balancing allowance. So since we don't have our sales proceed, which is same as scrap value, is 0. Our tax written down value is greater than our sales proceed. What type of allowance are we going to determine? Is it balancing charge or balancing allowance?
Balancing allowance.
Balancing allowance.
So balancing allowance, we also enjoy tax savings. Balancing allowance as at the end of these assets, the useful life of the project. So it is 3164. So 30% of 3164 will give us what?
949.
So for the whole of year 4, the value of tax savings for year 4 overall will be what? Please put your question on the chat box, please. I will read it through. The value of tax savings in year 4 is what?
949.
Okay, to the question.
Okay. 316.
At the end of the 4-year period, the equipment will be scrapped with no expected residual value. Any outstanding capital allowance, see it, any outstanding capital allowance at the end of the project can be claimed as what? As balancing allowance. As balancing allowance. So now, as at the end of the project, the overall tax savings will be this value here, this tax savings here, plus the 946, plus the 946. That is as at the overall tax savings for year 4. For year 4.
Sir, sorry, you wrote balance. Under that balance, you wrote 3614 instead of 3164. That was what I wanted to ask.
So it is the tax savings is 316 plus 946 as at the end of the project, as at the end of year 4, as at the end of year 4. So going back to the
So that thing is 949, no 946. That place you wrote now, the balancing allowance. I think it's 949, sir.
okay, all right, thank you. So the going back to the question, the tax payment is what? Is in arrears, right? The tax payment is in arrears. So the
Yes, sir.
tax savings will also be in that line. Once tax payment is in arrears, tax savings will also go in arrears. Will also go in arrears. So going by the question, for year 1, your tax savings is what?
750.
It's tax savings on capital allowance. Tax savings on capital allowance. For year 1, tax savings will come in what? In year 2. So tax savings is an inflow because it is reducing the amount you are paying as tax. So it's an inflow. It is reducing the amount you are paying as tax. So the tax savings is what? 750, right? For year 1,
Yes,
which
sir.
will come in year 2. In year 3, tax savings for year 2 will come in year 3, and the value is what?
563.
563. In year 4, the tax savings in year 3 will come, and that will be what?
422.
And in year 4, the tax savings for year 4 will come up in which year?
In year 5.
And that will be the cumulative effect of what? Of the value of 316 and 946 that we computed. So the tax savings will now be what? 316 plus the other value will give us what? It's 1265.
1265.
1265. So based on this, what will be your net cash flow? Based on this, the difference between your cash profits and this, and your tax payments plus your tax savings on capital allowance will give you what? Net cash flow. For year 1, you have what? 4,550 minus 0. You have
4,550.
For year 2, it will be what?
5,766.
76.
5,760. And for year 3,
4,950.
4,950. And for year
Year
4,
4,757.
okay. 4,757.
Yes, sir.
475.
Okay,
4,757.
4,757. Then in year 5, we're going to have what?
Minus 603.
603. 603. Now, looking at this is our net cash flow. There are certain things we still need to include because we are trying to determine our present value. As at year 0, do we have any cash outflow?
You
Yes.
As
have
at year 0.
additional working capital, 1 million.
Yes, let me do that here. Let me include that. We have outlay, initial outlay. That is our initial investment. The value is what? 10 million.
10 million.
Outflow as at year 0. 10 million. Any other outflow as at that period? The initial capital invested and working capital will be incurred at the beginning of the first year. So the working capital also is also as at year 0. So 1 million, that is 100. That is 1 million, yes, as at year 0 too. So we have
11 million.
working capital. Working capital. So the value is 1 million, so 1,000. So based on year 0, our net cash flow will be what?
11 million.
11 million. So at this point, you can apply your discounting factor to get your present value. Of each of these entries. So your discounting factor will be at what rate?
17%.
17%.
At 17%. 17% is clearly given in the question. This is the company's cost of capital is 17%. So this is your discounting factor. So as at year 0, what will be your discounting factor?
1.
To be 1. I've explained why it is always 1. Because as at year 0, the money value as at now is what the money can buy now. So there is no need for discounting it. Yes, and that is why it is 1, always 1. So as at year 1, what will be your discounting factor? Based on
0.855.
yes. So how do you get your discounting factor? We showed a formula we used to get that, and the formula is what? 1 plus what? R.
R raised to power minus n.
So 1 plus R to the power of minus n. N is the number of years you are looking at, or it can be 1 over 1 plus R.
Plus R.
1 over 1 plus R. So whichever approach you want to adopt. So to make sure that, let me see those in this class now.
Hello, sir. I'm on my way. Oh. I'm not at home, so I will not be able to talk. As you
You
want
will
to
watch.
see people in the class. I'm on the
You
way. I'm on the road.
no problem, ma. You will watch the video.
We want to see people in the class.
Yeah, as well in the class now.
I want to see the people in the class so that I will make sure that Madam Mary. I want to know if she's in the class. Mr. Charles, are you in the class?
Good evening, sir. I'm in class.
So can you help us with
Good evening,
the
sir. I'm here.
discount factor? Okay, fine. I want you to help us with the discount factor for year one.
Okay.
For year one, 0.8547.
Okay. So Mr. Charles, help us with that of year two.
Hold on, sir.
So Madam Choma, you help us with that of year three.
Okay, sir.
Ben, you help us with that of year four. Let me simplify it. This is what you have to do. But I just want you to make sure you can press that calculator. So
Thank you, sir.
So if you are pressing for year three, to the power of 1 we change to 3. To the power of 4 will be for year 4. So
Year 3.
All right.
0.624. 3.
0.624.
Okay.
Madam Chizobem, help me with 5. Madam Chizobem, are you in class? Oh, I'm pronouncing the name well. You know, though I like Igbo names. See, I can pronounce Chioma very well. I can pronounce Chikodili very well. So Madam Chizobem, I want to hear from you. So Mr. Charles, are you getting it?
It's giving me syntax. The calculator here, the lettering is bad.
Okay. Right. Okay. The objective is just for you to be able to get it. Yes, that is the reason why I'm doing that. So once you press, you should have 0.731.
Okay, 0.731.
Yes. So maybe after the class, you can still use, if your calculator is not working fine, you can try using your phone. But if the calculator is not working fine, do well to get another one.
Yeah, that's what I just came to just last night, and
Okay.
one of the calculator is bad, the other one, the lettering has faded. So I
Okay.
have to get another one. Yeah.
All right, sir.
Thank you, sir.
Okay. All right. So, Youth Ben, these are my just people. Youth Ben. So, can you give us for year 4?
So I told you I'm still looking for my calculator.
Wow.
I'm
That
using
is
phone, so I don't know where to press raise to power, sir.
Sir,
wow.
year 4 is 0.534.
If you want to get raised to the power, you change your phone calculator to scientific. You will now see power. So year 5 will be what?
0.456.
0.456. Okay. 0.456. So what will be your present value? Your present value will be what? Was 0? It will be
11 million.
11. And for year 1, 4550, 3,000.
890.
It's
3,890.
and for year 2,
4,211.
211.
421.
And for year 4, or year 3 rather,
3089.
3,889.
and for year 4,
2,540.
okay, 3,000.
2,000. 2,540.
Okay, you said 2,000, sir?
Yes, sir. 2,540.
2,540.
540. Yes, sir.
45. That's
0.
4757. All right.
275 for year 5.
Okay. 275
275.
for year 5. Okay. Yes, there is something. Something is happening. Our working
275.
capital. Our
275
working
instead of
capital.
2.
Yes, don't worry, don't worry. Our working capital is recouped as at year 4. When you go to the question, the additional working capital will be recovered in full as cash at the end of what? Of the 4-year. You see this statement, please.
Yes, sir.
So as at the end of year 4, where is it? This working capital, we should get it back here as an inflow. You get?
212.
So this value here, this net cash flow here, will change to the addition of 1. So I don't know if you get that, please.
Yes, sir. Yes, sir.
All right. So
That would be 3,074.
3,074. Then for the last year, the 5th now,
275.
that is in negative value, 275.
Sir,
So
the
what?
year 4 is 3,608. Am I wrong? 3,608, the year 4.
Yes. 3,608. Yeah, sorry.
For year 4,
Yeah. 3,608.
3,608. Wait, let me get something, please. So 5757 multiplied by 0.534, it will give you what?
Three zero seven four.
It will give
Yeah,
us
it's correct.
1,540.
It's correct. It's
Then
correct.
we have 1,000 as working capital.
So I think this is correct.
Okay, we're not adding
The
the
1,000 has been
1,000 to
added.
the 575.
We've added the 1,000 now.
No, if you do 6,575,000, that's going to give us 3,608.
We've added the 1,000.
Please, scroll up a little bit, sir.
Oh, okay, okay. 4757 plus 1,000. That is 0.534. As for okay, 3074.
Are you okay now, sir?
Yes, sir. Yes, sir.
So now, based on this, what will be our NPV? The NPV will be what? You add and minus the addition of these positive
2009,
values.
2,989. 989.
2,989. So based on this, if you are to write your report, what will you tell the director? What will be how will your reports look like?
That it should embark on the project that it has a positive NPV.
Yes, we should embark on the project. So you can just, if you want to write a report, that is to the director from you. The subject matter will be what? The recommendation, you understand, to embark on the project based on the net present value appraisal. So you just come up with a title that suits what you've done. Then you just write in 5 lines. You don't need to write story. This is not letter writing. It is what they will mark is your computation. So since it's, they say the report, you just come up with at least 5 lines reports, you sign, and that will be fine. Yes, Mr. Andrew.
Sir, thank you. My challenge here was managing to recover that working capital at the end of year 4, and then stretching this in beyond
Yes, sir.
4 years.
Yes.
Because the way I understood the question was like that additional working capital will be required like 1 million every year.
Okay.
That was
Okay,
how I
no.
interpreted the question.
Okay, you are the one that you are the first person that forwarded your assignment,
No,
right?
the
You
second person
attempt.
actually.
Second person,
Second
okay.
person.
Okay, it's Mr. Friday that was the first. Okay, you are the second, yes. Okay. Yes. So the working capital, sir, is to be recovered at the end, the whole lump sum you put in as at the beginning. You know, as at year 2, that working capital is still being used to run the business. So when we come to the issue of inflation, when we come to the issue of inflation, there will be a little increase from that 1 million, because inflation would have occurred in, let's say, year 1, year 2, year 3. So what will be the addition, the increase? There is a question like that. So that will be what we'll be recognizing in each of those years. But in this case now, that's the working capital introduced as at the beginning of the business year 0 is to be recovered at the end of what? The 4th year. So it is not that we'll be applying it every year, sir. Every year. We won't apply it every year. So the additional working capital required does not qualify. So let me see. The additional working capital will be recovered in full as cash at the end of the 4-year period. In full as cash. So it is not yearly recovery. It is not yearly recovery. It is just to be recovered fully as at the end of the 4th year. Is that clear, sir? So the spanning of the solution to the 5th year, it will always happen like that because tax is being paid in arrears. So the tax for year 4 will be accounted for in the 5th year. In the 5th year. So that is why you can see it in that order. In that order. Yes, Mr. Friday, what was your challenge? Why trying to solve the question?
It was just that allowance. I think that was really this thing.
Yes,
That
I can
allowance
see
part.
your workings. Your working is near perfect. Yes, because you actually recognize the working capital. Likewise, and yes. Yes, Madam Licia, what was your challenge? You gave us a negative MPV.
Okay, sir. Sorry, I've seen my challenge. My challenge there, sir, was including the depreciation and interest. I did it as if it was like they have like specific costs. That was what I kind of idea. You understand? So
All right.
that was why, and also that inclusive of when doing that profit, I included the interest and depreciation. And another thing was not recognizing that arrears. That was the two major things. That inclusive of that depreciation and what's it called, depreciation and the interest, and not doing that arrears. That's only the two major challenge. But I added the working capital and all that stuff.
All right. So thank you. The essence of asking us to attempt it is so that when we solve now, it will not just look new to you. That is the essence of asking us to make attempts. Yes, the attempt it does not show that you get it perfectly. But at least once you are picking figures, you know where these figures are being picked from. It means you've studied the question and it will not just look strange to you as we are doing it now. So that is the essence of asking you to make the attempt. Yes, because sometimes it's good you are ahead of your tutor. Yes, you should be ahead so that once he's talking, you already know where he's talking from. Okay, Ma, you said you have different values for MPV. What is the value you have, Madam Chuma?
Okay, I'm coming. Let me get it plus. What I'm having is 3,539. No.
So these your values here, are they correct, ma? All these values here, are they all correct? The PV.
Yes, now it's correct. I don't know.
I think you did not add the 5th year MPV.
The
Check
fifth
it.
NPV.
Yeah, the
Okay,
fifth year. You did not add it.
okay, let me
This
recalculate.
275.
Should not
It's
include it in the
1880, but the
calculation.
275. The 275 is
Okay, okay. You are right. Thank you. You are right. Thank you.
So
Thank you.
you're in this class. You don't know what we've done. Raise up your hand. Madam Esther. Tell me, what is the problem? Is it your network that is pushing you out? Let
Good
me know.
evening, sir.
Good evening, ma.
So sorry. And like the thing is, my network could not allow me join on time. It kept throwing me out, so I didn't join on time. That's the issue.
Okay, no problem. You go and watch the video and tell me
Okay.
the challenge.
Okay.
Yes, somebody else raised up a hand. Is it Mary or Joy? Is it Joy? Madam Joy.
Yes, I'm just joining.
You're just joining.
Yeah, for today.
Wow, that is serious.
Okay, good evening, sir.
Honor, sir.
Hola, Neta. Okay,
Yes, let me.
this month, honestly, I'm on the road.
Wow, this
Like
is serious.
this aspect of tax, honestly, I have used a lot.
Okay,
I don't
sir.
even know that we have brought the time down to 5 o'clock. I was expecting the 7 o'clock until when I go online and discover that it's 5 o'clock.
5 o'clock, sir. So that those of you that have FR can join FR later.
You know, some of us, in the nature of our job, sometimes you don't have time.
Okay.
Time.
The point is this, sir. You have to condition your mind to always watch the video. Yes. You have to, in watching the video, you assume you are also following it live. So as you write down the notes, you follow the video with your notes. In that way, it will be more interesting. Yes. But some people will tell you that they don't like going back to the video because they are not having a note to follow up with. They are not having a note to follow up with. So they are just watching, thinking the understanding will come like that. It will not work. Before you watch the video, you get your notes, you get the question, and follow as the tutor is explaining using the video. You understand? So I have an assignment. So, Madam Joy, you also watch the video and reach out to me anywhere there is issue. Reach out to me.
All right, sir.
Anywhere there is issue. But you try and watch the video tonight. Don't tell me till tomorrow.
Okay,
it is
sir.
when you are procrastinating, the videos will keep accumulating.
That's true.
So it will now become an issue. So you try and watch it. So I have like 2 questions I want to give as an assignment. Yes. So we are supposed to look at the issue of inflation. In inflation, we have the issue of money cash flow and real cash flow. Yes, and you all know inflation. Inflation is the persistent rise in the general price level of goods and services. So for you to factor in inflation into your computation, as the question might come, there are 2 approaches we look at: real cash flow and money cash flow. So this issue will be the subject matter of our discussion in the next class. We'll be looking at inflation as it relates to the NPV, investment appraisal. inflation as it relates to investment appraisal. So when you have inflation, you need to look at, is the inflation in real terms? Is it in general term? In that instance, so because we have two forms of inflation, we have general inflation, we have specific inflation. So the effect of the inflation on cash flows will have to be determined. So cash flows are classified into two. When we are talking about inflation, we can have money cash flow, we can have real cash flow. Yes. So where the question is telling you that the cash flow are stated in money terms or in real terms, there will be an adjustment for you to make. So we'll look at this, and there are various formulas we'll also look at in trying to solve questions on inflation as it relates to.
Okay, sir.
Sir, okay, sir, please, I have a question.
All right, sir.
Okay, this money cash flow, is it the same thing as nominal cash flow? Nominal term rather.
Yes, nominal term in real term, general term, real term.
Okay, sir. Thank you, sir.
Yeah, so when we come there, we'll see the various names being used for them. So, and there is a point you must note. When the question is stated in money cash flows, you will have to, it means the cost of capital will have to be adjusted to money cash flow. If it's stated in real cash flow, the discounting factor will also have to be stated in real cash flow. So we'll talk more about that. Then you can watch a video, one of the video on the YouTube before the class, to have pre-knowledge of what we'll discuss in that class. You check the YouTube link I forwarded, you see a video on real cash flow and money cash flow. You see that. So it's good you always have some, for this course in particular, because sometimes some of these things are what you've done over time that you in your schools, but in those schools they might not have put it to you as it ought to be. So it's good you always have some peripheral knowledge again before we come to class, so that they will not always look strange. So the assignments, before I forget, let's write, please. The assignment is this. The assignment is, at least I should be able to get the attempt to these assignments tonight. Madam Ruth.
Yes, sir. Good evening, sir.
No, I'm not disturbing you. You know you're a senior student. Yeah, Madam Vicky. So we have so Madam Esther, I'm using you now.
Sir?
I'm using you. So you make sure you give me the
Okay.
correct answer. Keku PLC is considering the purchase of a machine costing 1 million. 1 million naira. It's costing 1 million naira now. And the scrap value of the machine at the end of its 4 year the end of its 4-year lifespan or 4-year life will equal its written down value, the company can claim 25% capital allowance. 25% capital allowance on reducing balance basis for the machine. Operating cash flows excluding depreciation and before taxation are forecast to be mm, we have here we have our cash flow. We have year 1, year 2, year 3, year 4, year 4 years. And the cash flow, all these are in naira. Take notes, please. So the cash flow for year 1 is 400,000. For year 2, 400,000 likewise. For year 3, 300,000. For year 4, 240,000. The company cost of capital. Company cost capital. Company cost of capital is 12%. While corporate tax is 40%. It's 40% required. Determine the project's NPV. Hope we can solve this. You can go and make attempts and share your solution with us. So there is another one. That one is I would like to forward that one maybe when we talked about the issue of inflation. When we talk about inflation, then we'll have a comprehensive results. Okay, I can still send. This is quite question is very long. It's an SFN question. It's an ACCA question. It's very, very long. What I will do, I will forward it. I will do something about it. Do something about it. But it's not encompassing all what we've talked about. All we've talked about. That is what the question is all about. So the question wants you to calculate NPV, to calculate IRR, calculate payback period. Yes. I'll forward it.
We've solved it before now.
Not that one. There's another one.
Okay.
Yes, but this one I'm talking about currently, I can see it involve inflation, and it's better we talk about inflation before I forward that.
Okay,
So
sir.
that one is on. That one is still a small one. As at that time, we've not talked about taxation. So this one now involves taxation. It involves inflation. It involves working capital.
Okay.
So, but the format is exactly what we've done. Your sales, less variable costs, add your incremental costs, determine your profit, your taxation, your tax save, your scrap value, initial outlay, then your working capital. The working capital now involve inflation. Inflation is affecting the working capital. So that is why we need to talk about inflation. So once we talk about inflation, I think we are fine with it. Then should be able to attempt any question. So for tonight, I like to call it a day. It's not every day I'll stay till 7. So you go and watch.
Next time.
I tried my schedule for sir, please, you can forward it. You can forward it, sir. We just go through it. Maybe when we.
Okay, I will forward it. I'll forward it now. I will work on it and forward it now. So that
Okay, sir.
before the discussion, at least you read through. For those of you that have done inflation accounting in your undergraduate, you should be able to attempt it. Even by reading, you should be able to see the effect of inflation, yes, on the working capital. You know, if when they tell you inflation is increasing 5% each year, it means in year 1, 5% of that value. In year 2, that 5% will be to the power of 2. Yes. So in year 3, in that order. So that is just the effect. That will just be the effect. So I will forward it for those that want to work ahead so that
Okay,
they
sir.
can do the needful. So thank you very much. We'll see
Thank
on
you, sir.
Tuesday for performance
Thank you,
management.
sir.
Thank you, sir.
Thank you, sir.